Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of our partners, Schroders and Benchmark. I'm Sahar Nazir, I'm the news editor at Professional Advisor, and I'm going to be your host for the next hour. Now, before we get going with today's session, I'm going to quickly run you through the usual housekeeping. First of all, we're going to hear from our guest speakers who will leave time at the end of the session for questions. So please feel free to ask your questions using the chat function on your screens. I should inform you that this session is being recorded and we will send you a link of the recording by tomorrow. So please feel free to share this with your colleagues. Now, as usual, today's working lunch is going to qualify for 1 hour of CPD and we'll be sending you your proof of attendance along with the link to the recording of this session, which is going to arrive in your inboxes tomorrow. Now let's get on with the session. In an ever-evolving landscape marked by heightened geopolitical tensions, shifting economic conditions, and a dynamic regulatory environment, you financial advisors face increasing complexity in your roles. Joining me this afternoon to share the results from the latest Schroders UK Financial Advisor Pulse Survey released in May 2025 are Gillian Hepburn, Commercial Director from Benchmark, and Stuart Podmore, Investment Propositions Director at Schroders. Now, Gillian and Stuart will cover these results and walk through the key challenges facing financial advisors in 2025 and beyond. And to hear the advisor's point of view, we have Unique Financial Planning CEO Philip Martin, who joins the group as they examine the survey results. Now, the results focus on the key opportunities and challenges that advisors must navigate in the coming year. Do feel free to put any of your questions to Philip using the chat function, as I mentioned previously, and you will find that at the bottom of your screen. If you wish to remain anonymous, that's also fine. Just simply select my name. From my name from the drop-down list in the chat box before you type your message, so only I can see it. Just before I hand over to our speakers, I'm going to quickly run you through our learning objectives for today. By the end of this session, delegates will be able to evaluate client sentiment regarding investments and articulate the potential impacts on their portfolios. They will also identify and analyze key challenges and opportunities related to regulation, technology, and artificial intelligence. They will also prioritize and summarize the essential focus areas for the upcoming year. So that's the CII and CPD covered. So let's hear first from Benchmark's Gillian Hepburn. Afternoon, Gillian.
Afternoon, and thank you for having us on the working lunch today. We're always delighted to talk about the Advisor Pulse survey. So just as a reminder, the Pulse survey was actually introduced around COVID time, so a few years ago, where advisors and all of us were actually locked up, and we felt like let's do an interim survey and find out what was happening. And the survey was so popular that we've maintained it. The main survey that was 15 years old at the end of last year runs every November. So this is an interim one where some of the data that we'll talk about has a long life in terms of trends, and some of the questions are specific to what's happening in the market and the environment just now. So you will see a bit of a mixture in terms of some of the questions. But the good news for us is we construct the survey ourselves, and it's all about making sure, as it says, we've got the fingers on the pulse of what's happening and how advisors are feeling. And thanks very much to if you are on this call and one of the 272 advisors that completed the survey. Thank you, because without you, we wouldn't be able to deliver this insight. The 272 advisors is in line with previous surveys, so that's good news. And we do believe that that gives us a proxy for the market. So although I work and I'm commercial director at Benchmark, this survey goes out to the wider market that Schroders is engaged with in terms of advisors. And the other important thing to note before I hand over to Stuart is to say that the timing of this is really important. It was conducted between the end of April and the middle of May. And for any of us that can cast our minds back to that point in time, it was just post Liberation Day, where Trump stood in the gardens of the White House with a big list of tariffs that he was going to impose on various different countries. I think a lot of the stuff that Stuart will talk about to start with was very much influenced by what was happening at that point in time. And it definitely would be interesting to rerun the survey again to see if some of the sentiment that Stuart will cover will have changed. So with that little health check in terms of the dates and thinking about the impact of that, I'm going to hand straight over to Stuart, who is now going to start by talking about the market trends. And what I'll do is I'll interrupt now and again and ask Philip how that felt and how that translated into engagement with customers. So Stuart, over to you.
Thank you very much, Gillian. Thank you, everybody, for joining us today on the working lunch. Stew is fine, by the way, Gillian. I really don't mind. This is proving to be an extremely challenging year for market trends, right? I don't need really to tell you all of that. And as Gillian quite rightly pointed out, the timing of this survey is significant. Liberation Day on the 2nd of April. Just by way of introduction, some of the Deutsche Bank data that I was looking at for the month of April was quite intriguing. You could have gone to space with Katy Perry in the month of April and come back and be forgiven for asking the question, what was all the fuss about? Because the S&P 500 in the month of April alone was only down by about 0.6, 0.7%. The US Treasuries in the 10-year went up by about the same amount, and gold was up 5.3%. So that just puts into context the idea of snapshots and how dangerous those can be. But I think in the first piece of data that we have on market trends, and the advisors survey here, it comes as no surprise that people think that actually both bond and fixed income, both bond and equity returns are going to be challenged. So I look at the data here in a bit more detail, and the numbers of people who think that we're going to expect higher equity market returns has fallen slightly. Similarly with bonds, I think the fact that those two are correlated in our first response question suggests that people are recognizing the importance of producing, or at least enabling clients to enjoy resilient portfolios. We've often talked about recoding for the various outcomes that clients require. And I think we look very closely at the correlation of bonds and equities. So if our survey is right, if those returns are potentially going to trend downwards over the next 5 years for both bonds and equities, then our point about being genuinely diversified in multi-asset portfolios is well made. As it turns out, actually, those bond market returns, where clients on the right-hand side of this chart indicate that they think we're going to see lower returns for bond markets. Well, let's not forget, bonds are now producing the kind of levels of income which we might have seen in the past. It's looking pretty healthy. So maybe there's not the capital appreciation opportunities that there have been in the past, but as we've made very clear to people, there is a good income opportunity right now, just as an aside. Now, when we start to look at growth and we look at the way the market is operating, it comes as no surprise whatsoever in this chart that our respondents think that market volatility is going to trend higher. And I think that is clear on the left-hand side of this particular chart. I think it's also interesting that the numbers of advisors who think that global growth is going to trend lower has increased. And that reflects actually our macroeconomic forecast for this year. We've revised that down to 2.2% for global growth, where previously it was upwards of 2.6%. And we've revised upwards our inflation forecast over that period to about 2.6, 2.7%. So I think the advisors' response here in this survey certainly echoes and chimes with some of what we are believing ourselves. Just on that point on volatility, I would just remind the audience that we also have a Global Investor Insight survey, and that runs once a year, and some of those results have just been released at a similar time to this particular advisor survey. And if you're interested on a global basis, there are lots more of our different institutional insurance clients around the world. I noticed that 45% of those clients in the Global Investor Insight survey believe that the volatility over the next 12 months will be equal to, if not more than, the volatility we saw during the global financial crisis, which I thought was a staggering observation. And so the advisor survey certainly reflecting that. People really do think that volatility is going to be high. And with further announcements from Trump, and that's a justified perspective to take. In terms of that lower growth, what does that mean for the idea of inflation and interest rates? Well, your responses are quite interesting here. I think you're seeing structurally higher inflation on the left-hand side here. The number of advisors who think that there will be higher inflation has increased. There are also a slight increase to those who think there will be higher interest rates. I mean, I think from the Schroders point of view, over the last 3 or 4 years, I think we should give a shout out to the economics team. The forecasts for the direction of travel of interest rates here at Schroders has been very accurate. We felt on the way up that interest rates would be a little higher than the market consensus. And so far as that has plateaued out, particularly in the US, we also have the belief, relative to consensus in the market, that rates will come down at a slightly slower rate than the market expects. So I think these particular results from the advisor survey once again reflect to a degree that forecast from Schroders. And I think we ought to reflect a little more broadly here that, growth used to be the only challenge we were facing, but now we face a multitude of different challenges. The geopolitical challenge is significant. The idea of populist politics, as we see manifested through Trump, we see the potential for deficits to become an issue, as well as inflation. So the point here is that we're living in a multi-risk environment, and the rules have changed since the global financial crisis, and interest rates was heavily subdued, and there was a waterfall of money in the system. So therefore, it's our view that your portfolio should change with that as well. So a point there on lower and higher interest rates. It'll come as no surprise here on the next slide that our clients, through this survey, believe that there will be higher disruption, as I've already touched upon, related to technological advances as well. So I think there is a recognition that technology, that the use of technology, higher productivity in a very demographically challenged economy such as ours and others will be really important for growth, and that will cause disruption. I see that lower disruption through environmental change has been indicated by advisors here. That's come down to those expecting higher disruption on the right-hand side of this chart due to the changes in the environment has come down a little bit. Well, look, we know that the challenges of climate change are still there, and we know there's still plenty to do to mitigate those risks. So I found that result a little curious. I don't know whether that reflects how much we're talking about it in the communities of advice and investment. Maybe we're talking about it a little less, but we're certainly talking a lot more about geopolitics, and the news flow is heavily dominated by that. And in the next chart, we ask here about geopolitics specifically, and on the left-hand side, no surprises that the advisors, 77% of those advisors think that that's going to trend higher over the next 5 years. And on the right-hand side of this chart, higher deglobalization versus lower deglobalization. I thought this was interesting too. The number of advisors at 55% expecting higher deglobalization, that was really interesting. That was quite a jump. Now, we've talked about regime shift previously. We've talked about inescapable truths. We've talked about inflation being structurally higher. And when we talked about the 3D reset, of course, as well as demographics and decarbonisation, we felt that deglobalisation had a big part to play in keeping inflation a little bit elevated, especially post-pandemic. So it would appear there that advisors share that view, that supply chains are changing, and supply chains are being changed as we speak, and driven in that change as much by geopolitics as anything else. So I think there's plenty going on there, which the advisors are right to observe. So I'll pause there, and before we get into
thanks, Stu.
How advisors feel, maybe you might want to ask a couple of questions there, Gillian.
Well, Stu, thanks for that. I mean, obviously, it was really turbulent times, wasn't it, at that point? Philip, we are going to come on to look at how your clients were feeling about their investments, but Stuart outlined, or you used the word snapshot, and that's always a challenge, isn't it? It was a point in time when we did the survey where things were, well, particularly challenging. How were clients feeling?
Well, our client, we've always of time over a long period of time getting clients to understand that financial planning for the majority of them is a long-term game. You obviously will have some people in drawdown or in decumulation who get particularly jittery if markets take a downturn, and that's very understandable. But for the majority, they're understanding that of the volatility in the market and the fact that this may only be a temporary situation that will alleviate itself over time has only ever really requires us to get communication channels moving regularly with them. And the messages don't really change no matter what looms in the White House or the frequency with which it happens, which is long-term plans are about having a plan, making adjustments when required, invested, making sure you're investing in real assets that are keeping the ability of a real returns in excess of inflation. Those points are pretty well understood by our clients. So we tend not to get besieged by if that's a sustainable relationship.
Thanks, Philip. I'm not sure, there's a little bit of sound challenges there, but I'm hoping that they're okay. So with that in mind, Stuart, do you want to go on to what the survey told us in terms of how clients were actually feeling about their investments?
Yes, thank you, Gillian. So thank you very much for those comments, Philip. I'm going to pick up on a couple of those actually, but certainly the long-term nature of investing is an important theme. We run this sentiment question on the survey every year, and just to explain it, that royal blue color versus the navy blue color on the bars at 100% of our respondents in the survey. The navy blue bars indicate those clients or those advisors who are bullish about the market and whose clients are bullish about the market. So if you just look on the right-hand side of this, as at the Pulse survey of May this year, that obviously has significantly reduced. And we've discussed already as to why that might be. There was a lot of volatility following Liberation Day, and that has caused people to feel nervous, understandably. And in the royal blue colour, that's increased the number of people who now feel bearish. That's up to 43%. One thing I would say about this chart is that it's understandable how sentiment has changed during that period. We last saw only higher levels of bearishness, perhaps 22, 23, when people's bond portfolios in particular were challenged by the rise of inflation and the rise of interest rates. But if you look back all the way to, on this particular chart, to November 2019, that middle band of those who are neutral about whether they feel bearish or bullish pretty much remains constant. So I take that in a way, I extrapolate, maybe I'm reading too much into it, but I extrapolate that there is still a big chunk of the advised market that recognizes that whether you're feeling particularly good or bad about the markets, remember what the markets are doing and what your investments are designed to do for your financial plan. And in many cases, it's designed to work in the longer term and to provide a longevity of return into the future, inflation busting, as Philip mentioned, that is so important for most of us, rather than perhaps how you might feel either bearish or bullish in the short term. The next chart, I think, gets right to the heart of client concerns, and I'll be interested to hear what Philip thinks about this later on. Actually, we ask everybody to rank in order from the following options the three factors that your clients are most concerned about. And it'll come as no surprise that on this chart we have data on capital loss, inflation, generating sufficient income, and interest rates. Now, if I take those in turn, capital loss is very often in first place. And it's perfectly understandable that people will feel very concerned, a striking 81%, in fact, citing capital loss as their client's number one concern. It's up from 49% in the last survey, and it always takes first place in previous surveys. And we get that. We absolutely get that. So that drives, I think, a recoding of portfolios for resilience, and therefore some of the things we talk about at the moment around Schroders about diversification for resilient portfolios is relevant here. I think it's interesting looking at generating sufficient income, that has not quite as much of a concern and has slipped down to, I think, sort of second or third place. Generating an income is something that I've mentioned already. Bonds are now able to deliver, and I think that could be of interest in multi-asset portfolios as well as other diversified sources of income. And I look at the inflation and interest rate responses, and those, in terms of number one concerns, those have reduced. I think that reflects the fact that advisors are not quite as concerned as about inflation or indeed interest rates rising from here. And I think we would share that view, but it's just a case of just how long those interest rates, how long that inflation remains sticky at current levels. And as I've said before, we at Schroders are a little different from the consensus because we think it's going to be a bit stickier for a bit longer. And if I'm right about the resilience, if I'm right about the priority of resilience, that's reflected in the Global Investor Insight Survey. 55% of our respondents there said that resilience in a portfolio was the number one priority. Now, to just reflect a little bit on the longer term piece that Philip mentioned, we ask this question about interest rates, and we talk about advisors' conversations with their clients about long-term investing versus cash. This is an interesting one. So previously, that big blue chunk there on the bar charts is yes, I am having those conversations with clients about long-term investing versus cash. And that's understandable, right? When rates came up and people started to be attracted by 5.5% deposit rates, it's understandable. In May 2025, we've just broken that out a little bit. Those conversations are still happening, but a little less frequently now at 35% on the right-hand side. This is an interesting one. I mean, I think the biggest risk out there, and I'd be interested to hear what Gillian and Philip think about this, the biggest risk is still that people's portfolios don't provide the financial plans and outcomes that they need in life. In other words, as Philip rightly said, they need investments that are going to be inflation-proofed and resilient to maintain standards of living, maintain capital as they go through life, enabling them to enjoy it. Let's be quite honest about this. And I think that relying on cash deposits alone, or a significant chunk of that, is potentially dangerous and risks that plan. We did some research recently about a 10-year period here in the UK between 2013 and 2023. And we quantified approximately 500 billion quid that investors in the UK had effectively given away by just being in cash ISAs, or cash ISAs that track the Bank of England base rate, versus a simple allocation to global equity. And when you look back at 98 years of data across all different holding periods, you can see in our research that over any 20-year period, 100% of the time equities has beaten inflation. So I think those are relevant to throw in here, and are really quite important in the context of this conversation. The final thing I want to say before I hand back to Gillian is, you know, we've been talking about diversification. I mentioned it at Christmas when Gillian and I did presentations then on the main survey, just to draw your attention to the fact that there's a little tick up here in May 2025. We're starting to see advisors, financial planners considering the use of private assets, and that is certainly something that's reflected, or starting to be reflected, in our multi-asset offerings as well. So I think people are recognizing that diversification, resilience, correlation, enhancing of returns, and even providing income, those things are never going to change, but the way in which we deliver that potentially will. So that's it from me for the time being. Unless there are any questions, I'll hand back to you, Gillian.
Great, thank you for that, Stuart. Philip, lots of interesting stuff there. I mean, partly we covered it a bit earlier, but in terms of that number one concern on capital loss, I mean, I guess that's just, if you think about the demographics of your typical client, sort of pre-retirement, post-retirement, and into drawdown, when the market gets a bit wobbly, if I could call it that, that's a concern for them, isn't it? That pension pot that they need to draw down from.
Well, I wouldn't even necessarily say it's just a concern for them at a point of market volatility. It tends to be one of the
Yeah,
first things that comes up when you're actually setting a plan in the first place. People have worked hard, they've earned money. The first thing they want to make sure is that they don't lose it. So it's
absolutely.
almost integral in the whole process. I mean, I think Stuart raises a lot of interesting points about the need for the asset return to work hard and to provide that real return. But of course, the asset return can only do one bit. It's having to do quite a lot of heavy lifting in them, because the second part is that we've clients who are actually underfunded. They're not saving enough, and that's the needs to start doing more of the lifting. And that's very, very difficult in the current circumstances when cost of living is tightening people's budgets. And that's a really massive problem, obviously.
Yeah, and I guess aligned with that, not investing enough or and not taking enough risk potentially can be a challenge as well, particularly in that early accumulation stage. Are those conversations that you have as well?
Massively. I mean, when you're measuring, discussing attitude to risk with clients, the hardest conversation to have is with somebody who's determined to consider themselves to be balanced but can't afford to be.
Yeah.
Frankly, needs to achieve what they want to achieve with the resources that they have, and that's frankly where one of the big skills of good engaged planners comes to the fore. Telling people the unhappy they can't have everything that they might want.
Yeah.
And I think I would add something there, Gillian, actually, if I may,
Yep.
in response to a question about market volatility and changes in asset performance for vulnerable clients. I know you're going to come on to serving vulnerable clients. I want to emphasize that people shouldn't misunderstand what I've said regarding cash investing and longer term investment. Cash clearly has a very important part to play in financial planning. Philip will know all about that. That's certainly not my area of expertise, but I think, and it might well be that for vulnerable clients, that there might need to be higher cash holdings. I don't know, but what I do want to make clear to people is that when they've got a long-term investment horizon and they have certain goals to achieve, one of which is, of course, making sure that they don't run out of money, then that will drive how a portfolio should look.
Yeah.
Yeah, I
Absolutely.
completely agree with that. I mean, cash in our business, certainly cash and cash discussions, the principal purpose is not for the generation of returns, it's for liquidity. It's for the things that may need to happen. It's rainy day money. It's that kind of conversation, rather than there's an opportune window here because rates have spiked up, let's take it and up the weighting to cash. It tends not to be the kind of chat we'd be having with clients.
Okay, well, we can maybe come on to that in some of the questions, but let's crack on and look at the financial planning section and what you were telling us. We took the opportunity to ask about the impact of the proposals to include any unused pension pot into the estate for inheritance tax planning. So as a result of the autumn budget last year, and it's probably absolutely no surprise that 92% of you are saying that you're having conversations with clients about this, and specifically actually about wealth transfer that's been prompted by the proposed changes. Now, we are waiting, as we know, on some further regulation, but I think the view generally is that that will be about the mechanics of implementing this rather than the concept. So we used the survey then to ask advisors, well, if you are having conversations, what kind of strategies are you discussing with clients at this point? Probably no big surprise in terms of what the feedback looked like, but 81% of advisors said we're increasing withdrawals. So for clients already in drawdown, increasing withdrawals and then gifting out of normal expenditure. We're thinking about changing the order of which assets are drawn down from various tax wrappers. So rather than what happened before was typically leaving the pension last and drawing down from other sources, this has really changed the game in terms of what the financial planning or what the financial plan looks like. Now, we're always at pains to say that clearly, first of all, the pension was for pension income, but we do know that there are many clients sitting with pension pots that they had hoped to pass on to their to the next generation, to wider family, and this is this is now, because of the budget changes, become a really interesting point to discuss with financial planners as to how do we address this, what do we do? I think gifting is coming to the fore. There's a whole range of things. So at Benchmark, we've been supporting advisors through this, starting with what are some of the financial planning considerations, but also what are some of the soft skills that we get asked for? Can you help us with some of those difficult family conversations? And how do we start to approach this whole wealth transfer piece? And as many of you know, I've talked about wealth transfer in the market for many years, but maybe we're now at an inflection point when things will start to change. So again, that's something we can discuss. The simplest way to read this slide is just to consider that about 50% of the advisors that we spoke to in the survey said that about 50% of their clients will actually require an update to their financial plan as a result of the proposal to include the unused pension into the estate for inheritance tax planning. So clearly, significant number of clients potentially affected by this. And the other thing that was quite interesting, we asked about annuities, and what we've seen over the past few years, that the number of clients now discussing annuities with their advisors has continued to increase. And I wonder if some of this pension change is also driving that. Do we annuitize earlier, for example? So a number of things there that are going on. We then also asked about, I hate the term, but let's call them for today lower value clients. So we hear time and again in our main survey that the number of advisors prepared to manage clients with less than £50,000 to invest, which I always assume that maybe that could be next generation. Are you prepared to work with them? And that's dropped significantly over the years to only 25% of advisors. So we asked, what is your strategy for managing those clients? If you're not prepared to advise them, what are you doing? And it was interesting here that 53% said we want to try and develop a lower cost, lighter touch proposition to try and retain those clients. And we'll come on to, well, what are advisors doing in that space? Is it driven some of the statistics we're seeing around AI, but also targeted support, where we've got a slide on that, might change some thoughts around what we do with those clients. The other one we asked about was, as I said, we did have our fingers on the pulse. If there's proposals that are being discussed around limiting or restricting savings into cash ISAs happen, as you know, there's been debate about whether or not the limit into cash ISA reduced to say £4,000 or £5,000 out of the 20,000. Would that encourage more clients to invest more into stocks and shares ISAs? I was quite surprised by this, because 71% of advisors said that yes, they felt that this would encourage more clients to invest in stocks and shares ISAs. But I did see a statistic quite recently that said that the average subscription into a cash ISA was less than £5,000. So interesting. Will this really drive more clients to invest as opposed to hold cash? I'm not so sure, but then I'm always open to debate on this. Philip, if we go back to the pensions discussion for a minute, what's your thought on that? Are you starting to have conversations with clients?
Yeah, I mean, we take a general view with giving advice around any form of tax wrapper that you could only give the advice based on the rules as they sit at present. So we tend not to wish to give advice that is dealing on the speculative part. The fear I've got, which we didn't really touch on, is that there is a risk here that this back end attack, nobody wants to give money to the taxman at the back end, so that will be driving annuity conversations definitely in order to use it earlier. But I do have a slight fear that it starts to actually taint the whole pensions box idea, and we actually start to go backwards with pension savings for fear of people feeling that they're going to have unused assets that the taxman's going to get their hands on. And as a general message to an undersaved population, it's not very clever and not very joined up. That would be my fear of the overall proposal, obviously.
Yeah,
Yeah, and that's a really good point, actually, because in some respects, we're actually just reverting, aren't we, to what the regulations were some time ago anyway, in
Correct.
terms of the taxation on
Correct.
pensions. And I think
Correct.
a number of people forget that that's the situation. Yeah,
It was George Osborne that decided to blur the lines as to what a pension was. It was always completely understood to be providing income in your retirement. Then he decided to turn it into an asset conversation and cascading it through generations, and that changed the chat.
change the chat. Yeah. So,
Yeah.
but what this is absolutely demonstrating, isn't it, and some of the earlier things we discussed, is the absolute value that advisors deliver to clients at the end of the day. And
Yeah.
across a whole number and a whole range of different areas. You know, it's not just about the investment piece, and we know that it's about all of these other things. As regulation changes, you know, the role of the planner is to sit and think about the impact on the client and have those discussions.
I mean, I think, and the cash ISA discussion is a very, very interesting one too. We don't see cash ISA business, in our advice business, very, very rarely. And then
Yeah,
obviously that is dominated by the banks themselves from walk-in existing customers. So I suspect that we're looking at two different cohorts of
of course.
potential clients. But for a chancellor that's trying to get growth into an economy, I absolutely follow the logic that we shouldn't be using tax money to subsidize deposit accounts. It just, it's doing nothing to help fuel the wider economy for money that may be saved anyway. So I everyone will have their own view of this, but it
Absolutely.
seems like a sensible, coherent, thought through policy, and I think it should, in principle, drive more into stocks and shares ISAs, which in principle is a good thing.
Absolutely. So moving on to one of our favourite topics, consumer duty, and some other bits and bobs on regulation. We asked about the priorities for advisors in terms of ongoing implementation of consumer duty, and this is stayed exactly the same. It's the ongoing assessment of fair value, but using client feedback. So how do we absolutely know that we are delivering value to clients? And I've always said, just because they stay doesn't mean to say that they think they're deriving value. And certainly at Benchmark, we have quite a robust process now in place where we looked at value, we did a piece of work with Boring Money, assessed and identified the factors that clients identify as delivering value. And then we test against them. So after every annual review, the client gets an online survey to complete. So it's about how can we help advisors with a specific challenge, given that it's still number one on the radar. I think what was also interesting was the piece around vulnerable clients. Clearly, it's coming in at number 3, but certainly the conversations that I have with advisors is that this is an area that they need to spend time focusing on as well. And we saw some interesting conversations from the regulator earlier in the year. This next question, again, similar levels as before. Do you think the fair value outcome will put pressure on the ongoing charging model? And I think the word model is important here. It's not about the amount that's being charged, it's about the nature of the charge. And actually, Next Wealth did some really interesting research early in the year that some of you might have seen, where they looked at overall fee models. And what we saw was some interesting changes where advisors are starting to think more about fixed fees, subscription type models, and actually more of a combination of both. So I think this one will be an interesting one to continue to track going forward. I mentioned vulnerable clients. I think interesting, we're still seeing here 65% of advisors saying that less than 10% of their client bank are being identified as vulnerable. That feels slightly at odds with some of the statistics that the regulator is proposing. So again, this is one that we'll continue to look at as we work towards our next survey. And then here's an interesting one. Will the FCA's review of the ongoing advice services prompt you to take some action within your business? Now, what we didn't do is asked the 64% who said yes. We didn't ask, what exactly are you doing?
What?
But I hit what. So I think that's one that we've missed out on, and we will ask that in the next survey. But maybe the what is actually making sure that the evidence is being collected and it's being documented. There's this piece, isn't there, about if it's not written down, it didn't happen. So I think this will be an interesting one as we go through the rest of this year to see what are advisors doing in this area, and and how are they changing their approach to like ongoing service and annual reviews. And then one that we might want to have a little bit of a debate around was targeted support. This was clearly done just before the FCA announcements last week and their consultation paper. But I thought this was higher than I would have expected, which is one of the areas of fun with the survey. You never know what you're going to get back. But 46% of advisors said that the proposals would prompt them to think about a new proposition for some or all of their clients. And Philip, quite a lot in that little section there. Is anything specific that jumped out for you?
Well, I think the fair value point. I'm massively in favour of this. Actually, I think that this has been a real catalyst for us getting far better and far smarter at actually articulating to clients what our proposition is and how we deliver it. So it's one of probably the biggest change I've seen in my 38 years in this industry, is that we have quite definitely shifted from I'm here to arrange the setting up of your pension to I'm here to deal with all your financial planning matters, and we'll do this hand in hand together over a long period of time. And that is a really good thing. And I think fair value goes absolutely to the heart of that, because once clients understand what it is you're doing for them on an ongoing basis and how that planning process works, we find they're more than happy to, we have no quibble with fees at all, because there's a far better articulation of what's actually beeen delivered. So it holds no terrors. I think it's a very, very good thing.
Yeah, I think it's a really
10%
interesting point, Philip, isn't it? We one of the other questions that we ask in the other survey is this whole impact on the business, and pre-implementation advisors were saying it's just like TCF on steroids. It's a bit more. We just need to write stuff down. We're doing it anyway. And I think there's been this huge realization that consumer duty is a force for good. It does make us sit back and look at what we're doing for clients and how we work with them.
And also, are we doing it consistently across the whole base?
Exactly.
Which is really important in sizable scale businesses.
Yeah. Okay, anything else on that one, or we just finish off and then have a chat?
I'll just add something very quickly there, Julian, on the consistency point. It's also important on the investment side as well. So when we're looking at products and we're looking at product development in particular, then that sense of value for money is really important for us too. And one of the ways, if you look back at various investment histories, one of the ways of delivering value is doing so incrementally and consistently over a long period of time. That this is not about shooting the lights out in investment performance one year and then crashing and burning the next. I think from our point of view, we've recognised for a long time that this is about consistency of process and performance and teams where possible, and understanding how and why those returns come in as they do. And that can often give, I think, quite a bit of comfort and reassurance to Philip and his clients.
Yeah, absolutely. And it's interesting that the top, when we looked at the value factors that clients identified, number one was trust and peace of mind. And that resonates right across everything that we do for clients. So I'm just going to finish up on a couple of points on technology. It wouldn't be a survey without asking about AI. And we're still seeing this upward trend in terms of advisors thinking about AI in terms of an opportunity for their business. But I think this next slide was really interesting for me. So what we saw on the left here is that 37% of you have already implemented some form of AI in the business. So there's I think there's a lot of test and learn going on here. So how can we really implement it and make a difference? I think the other stat is on the right-hand side of this chart, where those only 2 years ago, 27% of you said, I am never going to implement this in the business. And that's dropped to only 7%. So there's been a real shift in the sentiment towards using AI in the business. And again, one to continue to watch going forward. And we also asked, well, where do you think it's going to help you? And it's probably no surprise here that 75% of you said it's all about efficiency and automation. It's about leveraging efficiency to enable you, I think, to spend more time with clients, delivering that trust and peace of mind that they value. So I think a lot of this is sort of inextricably linked, if I could describe it like that. And then lastly, I decided to stick a new question in around social media. What are advisors doing and why? Interesting to note that 56% of you are using LinkedIn in a professional capacity within the business. Nobody's dancing on TikTok. I thought X, as I have to say, formerly known as Twitter, has dropped to only 2%. Now, I remember a few years ago where that advisors, I think, were quite active on Twitter, but that's definitely fallen away. And there's a little bit of Instagram going on. So just interesting to see what everybody is doing. And then we asked, if you are in social media, what's your primary reason? And interestingly, it's around brand presence. So 28% of you said this is just about being visible in the market, having a brand presence. Interestingly, 16% said it's about financial education, which has got to be a good thing. And then only 9% said it's about attracting new clients. And I think actually at the end of the day, the brand presence tongue twister and financial education has to really, doesn't it, at the end of the day, to trying to help attract new clients. Yeah. Philip, what's your thoughts on some of that? Obviously AI and the social media piece before we go open to questions.
Yeah, well, I think the AI question, you're right. It's inevitable. You've got to ask it, but I think you'll see that shift. I think that will continue to accelerate, and those who are saying they're not going to use it, I think, are going to find themselves in a position where they're going to end up having to use it, because as margins get squeezed and income levels start to drop, people are going to have to start to look for efficiencies in the back office. And there is an obvious way of tying this all together back in with consumer duty and consistencies of outcomes and, similar documentation for similar circumstances going to similar clients. It's just going to be a massive boon. As it is, right across the economy, it's going to be. So I think as you carry on asking that question, I'd expect to see these numbers continue to tick up.
Yeah,
and I think something there, Gillian, as well. Just very quickly, I might be talking beyond my comfort zone, without doubt. But on that social media platform, I thought it was really striking that 0% are on TikTok. I mean, if you look at those different platforms and you think about succession planning, you think about intergenerational wealth transfer, then the financial planning clients of the future, whether they're getting that up to 50,000 service or beyond, fully bespoke or model portfolios, whatever the model is, right? It seems to me that there's going to have to be an increase in financial planning presence on TikTok. That's where the next generation is undoubtedly getting its information. And it worries me. You listen to Moneybox on Radio 4 on a regular basis, and there are stacks of people out there offering influencer-led financial planning, in inverted commas, which is dangerous, quite frankly. So I think that I thought was really striking to me.
Yeah, well, it was interesting in the last financial life survey from the FCA, they said that 45% of investors aged between 18 and 34 said that they use social media to do their research. So your point is absolutely well made, Stuart, isn't it? It's out there. Yeah. Anyway, with that, I'm going to hand back to Sahar to host some questions with us. Sahar, over to you.
Thank you so much, everyone, for a really interesting presentation. I think there were certainly some statistics in that survey that have surprised me, and I'd like to come on to that a bit later. But first of all, I mean, we've got some time to answer some questions. I can see that someone has sent through a question on vulnerability. The question is, how do you feel increased market volatility and changes in asset performance are currently impacting more vulnerable clients? I mean, whoever wants to answer that one first, I'll leave it to you guys.
Well, I think the increase in volatility that I talked about is certainly worth paying attention to. And then to stray into the world of financial planning on the back of that, Zahara, I think it really does depend on individuals. I mean, the vulnerability and the specific vulnerability that's being described, I suspect, because there are clearly a range.
I think that's completely the point.
Yeah, in a way, it doesn't matter who you are and what you're doing. Market volatility is going to affect those investments, but I think setting up a plan and working out whether or not that plan needs to change in the face of that increased market volatility is the key question to ask and to answer for any client, whether vulnerable or not, would be
Thank you for that, Stuart. Gillian, did you want to add on to that at all? I don't know if Stuart broke up there.
I don't think Philip does there. Philip?
Yeah, so the only thing I'd maybe add to that is that if you've got clients who are responding unfavorably to short-term volatility as a result of how they've invested in the plan, then the plan's wrong. Just self-evidently, you've not discussed that as a particular risk or understood where that risk sits in their hierarchy of concerns. Because if it's too high, it should have been reflected in where they were invested in the first place. So it's sort of circular. But Stuart's bang on. It will depend entirely on what the vulnerability is, because it is really about economic vulnerability rather than health-related vulnerability, for example, would have no impact whatsoever.
Yeah, I was going to say the same. That there's different definitions of vulnerability, and if it's clients with financial vulnerabilities, as Philip said there, then that would be very different from somebody who has other types of vulnerability. So it's very much, I think, client specific, I would say.
I agree with that. Yeah.
Yeah, thank you for that, guys. Gillian, I did want to ask you something about targeted support, because that part of the survey definitely stuck out to me. The survey did find that it was nearly half of advisors that say that they would consider a new proposition in light of targeted support. Do you think that the advice market is finally ready for a scalable hybrid models? And where would you say that Benchmark sees its role in enabling this?
Well, it's a great question, isn't it? I mean, obviously the survey was done before the FCA draft documentation came out last week. So it was done without, I guess, understanding what that was going to look like. I think, first of all, you absolutely have to welcome anything that will help address the advice gap. For anybody who's read the documentation, to read that 12.5 million people are under saving for retirement. I think Philip picked up on that point earlier. Only 9% of people received regulated advice in the last year, and 61% of people with more than £10,000 to invest are holding those assets mainly in cash. We've talked about that as well. It seems to be significant opportunities here to help people on their savings and their investment journey. And so, anything that does that has got to be a force for good. I mean, clearly we're in early stages, having had the draft regulation and asked for response. We're digesting that at the moment to think what challenges and opportunities does that give us all right across the industry. And interesting, one of the points that was called out was that appointed reps are not included at the moment. Obviously, for Benchmark running a network, that's something for us to consider. But we do have our own advice business as well. So we just need to think about what does that mean across the industry, and also for the broader group. What are some of the opportunities here, but also who is likely to deliver targeted support? How do we work with them? What's that going to look like? So I think it's relatively early days yet for some of this. But given the statistics that were quoted in the FC documentation, there is a stark need, I think, for something which will encourage more people to think about advice and to think about their future.
Absolutely. I also can see that someone has sent through a question on artificial intelligence, because it was a really interesting part of the survey, Gillian. They said, I would like to know your opinion about AI when it comes to assisting with generating portfolios, automation, and helping with reports, etc. So do you think that your clients have trust in artificial intelligence? What do you think about that, Gillian?
Well, it's a great question, isn't it? Because I think we'll probably get to a point when people don't even realise that artificial intelligence is being used somewhere in the system, possibly in years to come. And let's face it, it is still relatively new. It's only a few years ago that we all started to play with ChatGPT over Christmas, maybe 2-3 years ago. So it's still in some respects in its infancy, but what we've seen is AI taking off at pace, and it just cannot be ignored. It feels to me like the advice process is absolutely ripe for this type of automation, in terms of, if you think about it at its core, taking data, sort of hard facts from the fact find, and supporting the production of the suitability report. So there's got to be significant opportunities here. I think some of the challenges we need to think about are obvious, right? Where is the data going? And let's make sure it doesn't get put into the internet, into somewhere that it shouldn't be. So obviously security of data is really important, but also is selecting the right provider to work with you. Because at the moment, I often talk about the advice process being sort of from here to here. And what we see often is the AI technology that we look at re-engineers a piece of it. So what we've got to do is make sure that we can integrate data. So data's key in all of this. It's that whole garbage in, garbage out. So one of the things is to think about what's the problem that we're trying to solve here. And to what extent does AI support that? I mean, don't get me wrong, I am a massive advocate of this. I think it's got huge opportunities right across our industry. But one of the things we did, we were very aware of advisors in the network and starting to look at a number of different AI providers. And we provided a checklist in terms of thinking through some of the due diligence questions that you might want to ask, and how can we help advisors to pick the right provider if they want to start working with somebody in the AI space. So we're always keen to make sure that we give advisors sufficient help and support. But obviously we're looking at that ourselves within Benchmark. You know, how can we deliver technology that continues to leverage efficiency for those working with clients, and how do we do that to enable them to spend more time, as I said earlier, with clients. So it's really important, but we've got to make sure we all get it right.
Philip,
It's the same
Yeah,
for us as well.
Sorry.
Sorry, Stuart.
Well, I was just going to add, it's the same on the investment side. I mean, just to answer that question about how it comes into assisting with generating portfolios, to Gillian's point, it already is. So here in our public markets, as well as our private assets, AI is being used in the collation of and the analysis of information. We process a huge amount of information that goes into a lot of our fundamental analysis for active portfolios. And private asset investing especially is far more challenging because of sometimes the lack of access to that really important information. So collating that, understanding it, trawling through it and extracting the key points. Well, we've already got AI helping us with that. And end clients, those final consumers might not be aware of that, but it's already alive and kicking.
Yeah, I think the only thing I would, it's a great question, but the only thing I would add is the last time I checked, the FCA has not regulated Siri and Alexa, has it? So, in the end, there's always going to be a human that takes that output and puts their own name at the bottom as a regulated entity to say, this is the advice we're giving you. So a situation to try and convince clients to take recommendations from AI doesn't in effect exist, because it's going to need the regulated interface in order for it to be advice. I just don't ever see that changing. I don't ever see a point where an AI will produce a plan and put it out and no human will ever touch it, because a regulator's not going to permit that.
Well, thank you so much,
Rightly.
everyone, for a really interesting presentation. I think that's all the time that we have for questions. I just need to, just before we wrap up, I'd like to take a quick look again at those learning objectives. We did say that by the end of this session, that delegates will be able to evaluate client sentiment regarding investments and articulate the potential impacts on their portfolios, identify and analyze key challenges and opportunities related to regulation, technology, and artificial intelligence, as well as prioritize and summarize the essential focus areas for the upcoming year. So that's all the time that we have for today. Thank you so much for your questions, and thank you to Gillian, Stuart, and Philip for joining me and for letting me know, and you folks at home, to grill them with your questions. On that note, if your question didn't get answered, Schroders will do their best to do so after the event. So please do send them through. And before we close up, I should assure you that your CBD will be delivered to you tomorrow. Just before we do close, I want to leave you with a teaser of what's to come from PA events over the next couple of months. So our final online event before the summer break is going to take place on the 23rd of July. And this is when we will continue with another working lunch, this time with Bailey Gifford. And we're going to be joined by Ian McCombie, Head of UK Equities. And he is going to give us an update on Bailey Gifford's UK Growth Trust. Following the summer recess, we're going to be back on the road again with our autumn multi-asset and MPS roadshow. And we start on the 10th of September at a brand new venue for us. This is going to take place at Wetherby Racecourse. On the 11th, you'll find us at our usual Cheshire venue in Warrington. And then the following week after that, we're going to be at the Vale in Cardiff on the 16th. This is Bristol's. We're going to be at Bristol's magnificent Lee Court on the 17th, and that's where we'll complete our roadshow in London on the 18th. During the roadshow, delegates will hear presentations from Aberdeen, Aviva Investors, Downing, Quilter, Rathbones, as well as Standard Life. The following week, we're crossing the border for our annual Scotland Investment Roadshow, where you'll find us in Edinburgh on the 24th of September and in Glasgow on the 25th of September. We're going to have an eclectic mix of presentations for you in Scotland, where you will hear from Copia Capital, Downing, L&G, Orbis, Schroders, and Tatton Investment Management. On the 2nd of October, we'll be back in Warrington at the Park Royal Hotel and Conference Centre with our annual PA360 North Conference. And this is where you'll hear presentations from over 20 industry experts, as well as have the opportunity to meet all our sponsors in the exhibition area of the conference. So please do come along and network with our sponsors and your peers at what is now firmly established as the largest management conference for advisors in the north of England. So all in all, that's a total of 12 hours CPD. As ever, if you wish to find information on or sign up to any one of our events, you can do this by visiting professionaladvisor.com/events. So that's it for today's session. All that remains for me is to thank once again Gillian, Stuart, and Philip for their presentation and for answering our questions. But as ever, our greatest thanks goes to you, our readers, for your company this lunchtime. I trust that you found the session helpful and worthwhile. And if you did, perhaps we'll see you again soon. Goodbye.